Welcome back to our channel where we explore financial planning strategies to help you think through your options and make informed decisions. Today, we're comparing three tools that often come up in planning conversations: 529 Education Savings Plans, Indexed Universal Life Insurance or IUL, and the Infinite Banking Concept or IBC. Our focus will be on the flexibility each option offers, particularly when it comes to how and when the accumulated funds can be accessed. This is an educational overview. None of this is financial, tax, or legal advice. We strongly encourage you to work with your licensed advisors before making any decisions. Let's start with a clear definition of each tool, because a lot of confusion in this space comes from people conflating them. A 529 plan is a tax-advantaged savings account. It's designed specifically for education expenses. The growth inside it is not taxed, and when you withdraw funds for qualified education costs, those withdrawals are also not taxed. That's a real benefit. But it comes with a narrow lane. IUL, Indexed Universal Life Insurance, is a permanent life insurance policy. The primary purpose is a death benefit for your beneficiaries. It also builds cash value over time, and that cash value is credited based on the performance of a market index, subject to caps and floors that vary by policy. I want to be clear from the start. Those values are non-guaranteed projections based on current assumptions. What you see in an illustration is not a promise. IBC, the Infinite Banking Concept, is not a product. It's a strategy that uses a whole life insurance policy as a personal financial reserve. The idea is that you fund the policy beyond the minimum premium to accelerate cash value growth and then borrow against that cash value for things you'd otherwise finance elsewhere. It can be a powerful approach when it's structured correctly and the client is disciplined, but it's not magic, and there are real costs involved that we'll cover. One thing I want to name early and keep naming: none of these are investment products. IUL and whole life are life insurance policies. How we talk about them matters, both for your client's understanding and for our regulatory obligations. Now let's look at where these tools actually differ in terms of flexibility, specifically what you can use the money for and when. On access, a 529 plan is education only. If you pull funds for anything other than a qualified education expense, you'll pay ordinary income tax on the earnings plus a 10% federal penalty. That's not a small thing. It can be a real problem if circumstances change. A child gets a scholarship, decides not to attend college, or the family has a more pressing financial need. There is now a limited Roth IRA rollover option under recent legislation, but eligibility rules apply, and your client should confirm the current specifics with their tax advisor before counting on it. UL and IBC-style strategies, by contrast, allow access to cash value through policy loans for a much broader range of purposes. Education, yes, but also business needs, a home purchase, an emergency, retirement supplementation. That flexibility is real. What I want to make sure we're saying accurately is that accessing that cash value through policy loans is generally not treated as taxable income, while the policy remains in force. The tax treatment is not absolute and depends on how the policy is structured. Your clients need their tax advisor to confirm how it applies to their specific situation. On retirement, a 529 isn't designed for this purpose. Full stop. IUL and IBC-style strategies can potentially provide a source of supplemental income in retirement through policy loans. That can be a meaningful planning tool. But again, the values are non-guaranteed and the strategy has to be managed actively over time. On business use, 529 funds cannot be used here. IUL cash value and IBC-style loans can be, and that's a conversation worth having with business owner clients. Let me spend a moment on IUL specifically, because these are the details that trip up conversations in the field. First, tax-advantaged access, not tax-free access. This distinction is important and non-negotiable in how we present it. Policy loans from an IUL are generally not counted as taxable income. That's a real benefit. But that tax treatment is not unconditional. It depends on the policy not being classified as a modified endowment contract, the policy staying in force, and the individual's specific circumstances. We never say tax-free, we say tax-advantaged. And we point clients to their tax advisor to confirm. Second, cash value growth is non-guaranteed. The illustrated values your client sees are based on current assumptions. The index crediting rate, the caps, the cost of insurance charges, these can all affect actual performance. What's in the illustration is what the policy could do under current conditions. It is not a projection of what it will do. Third, and this is the one that catches producers, loan and lapse risk. When a client takes a policy loan, it reduces the available cash value and the death benefit. If the policy lapses while there's an outstanding loan balance, the loan amount may become taxable income in the year of lapse. That's a real exposure. Clients need to understand this before they borrow against the policy, and producers need to monitor these cases actively. The infinite banking concept gets a lot of attention and a lot of overpromising. Let me walk you through what it actually is and what it isn't. What IBC is. It's a strategy that uses a whole life insurance policy as a personal financial reserve. The policyholder funds it above the minimum premium, sometimes significantly above, to grow cash value faster. They then borrow against that cash value for major purchases or financial needs instead of going to a traditional lender. The loan repayment terms are flexible because it's borrowing from the policy rather than from a bank. What IBC is not. It is not risk-free. It is not guaranteed. And it is absolutely not an investment product. Here's the thing I need every producer in this room to say accurately. The insurance carrier charges loan interest on any outstanding balance. That interest compounds over time and reduces your net death benefit. The idea that the interest stays in your system, which you'll hear in IBC marketing, is a simplification that can mislead clients. There is a real compounding cost. It needs to be disclosed clearly. The other thing, this strategy only works if the client is disciplined. Sustained premium contributions, active loan management, proper policy structuring from the start. If any of those breaks down, the policy can underperform significantly or lapse. Before you recommend an IBC-style approach to any client, there needs to be a formal illustration reviewed with the client, and they need to understand what they're committing to. So let's bring this together. 529 plans do one thing really well: tax advantage savings for education expenses. If your client has a child heading to college and they're confident the funds will be used for education, a 529 is a strong purpose-built tool. It's not the right vehicle for clients who need flexibility or who have broader financial planning goals. IUL offers something different: a life insurance policy with a death benefit and a cash value component that, when properly structured and managed, can provide tax advantage access to funds for a range of purposes. The values are non-guaranteed. The risks are real. But for the right client, with the right expectations, it can be a meaningful part of a comprehensive plan. IBC-style strategies offer the broadest flexibility, but also the highest discipline requirement. Loan interest is a real carrier cost. Results are not guaranteed. This is not a strategy for clients who aren't prepared to commit to it long-term. For clients who understand the structure and are well-suited for it, it can be a powerful tool. What none of these are is a replacement for a qualified advisor team. Before any client takes action based on what we've covered today, they need to be working with a licensed insurance producer, a CPA, and in many cases, an estate planning attorney. Our job is to make sure they understand their options clearly, accurately, and without overpromising. I'm happy to take questions, and I can walk through a personalized illustration with any client who wants to see how any of these tools might apply to their specific situation. To wrap up, 529 plans are purpose-built for education savings and do that job well. For those who want a financial tool that can adapt to a broader range of life circumstances, IUL and IBC-style strategies offer meaningful flexibility as part of a broader plan developed with qualified professionals. If you'd like to see how any of these strategies might fit your specific situation, we'd encourage you to connect with a licensed advisor who can walk you through a personalized illustration. Thank you for watching. If you found this helpful, please like and subscribe, and leave any questions in the comments below.